We have a question from Garrett here today. I got over 200 questions yesterday to my email whenever I posted that I'd be taking questions and making YouTube videos about them. And Garrett says this: Nick, you said you add new positions to a trade as long as it is somewhat reasonable. What does that mean exactly? And do you add as long as the last added position has a reasonable risk reward? And if so, what do you consider reasonable? Well, Garrett, we're going to talk about this today. What I do is I ask myself how much potential for profit the trade has. Now, I understand the subjectivity behind a statement such as this, because how much true potential does price have to move in any given direction? It is truly just a figment of the imagination, because price could quite literally continue moving in one direction forever without ever having pulled back to your entry. And had a trader simply entered a position in that direction and then protected the position with a break-even stop loss, they have a trade that continues to go up and up and up. For example, if you were to buy the S&P 500 and catch the dip the very moment that it reverses and continues up to make new highs in the daily and weekly charts, you could quite literally have a potential entry in which price never comes back to your entry. And so what would be considered reasonable in the context of Forex trading? Forex has a very interesting movement pattern in which it is largely random, and yet it has a lot of mean reversion characteristics. Quite simply put, the more price goes in one direction, the more likely it is to revert. And this goes against the common trend logic that a lot of people will say when scalping indices and equities futures. They'll say that the more price continues in one direction, the more likely it is to continue in that direction. If that's true, then by Garrett's question, we could say that it is just good to continue adding to positions and then never closing them and never worrying about, okay, it's unreasonable to add at this point. Because after all, the more price goes in one direction, the more likely it is to continue in that direction, right? At least in Forex trading, I'm of the opinion that this is a complete fallacy. It doesn't make any sense, and I'm going to show you why here on the chart with examples. Consider this trade that I'm in right now. In my group where I call all my trades out live, I'm currently in a sell on GBP Canadian dollar. The sell's down here, the stop loss is somewhere above the zone, and the target is somewhere lower for at least a 1-to-1 risk-reward ratio. So the trade looks something like this. So the whole focus of Garrett's question is to ask, when is it reasonable to add to a winning trade? And does it matter what the risk reward for the subsequent entries are? And is there a location where it would be considered unreasonable to add? Now, I'm going to give you the simple answer, Garrett, and to those of you who are watching. The simple answer is that I will generally add to a winning position until it gets about a third of the way to the final profit target. Now, as with anything in trading, this is subject to change based on discretion and context and price action and everything like that. Your experience will quite literally make or break whether or not you choose to hold a trade, add to a trade, close a trade. There are a bunch of different things that go into that decision. But generally speaking, should price start moving into profit, for example, say down here to where you see the shown alert here on my TradingView image, what I would essentially do is I would add to it, and then now we have two positions. Now it's important to consider that with two positions now, with the same lot size and the same distance of stop loss, in this case 325 pips, the stop loss locations are different and the profit target locations are slightly different. And what this also means is that if price does turn around from here and go up and hit both of the stop losses, you would now lose double than what you originally risked on the trade. Is this the best way to add to a winning trade? In my opinion, there are more optimal ways to do so, of which I'll get into right now. A more optimal way to do so is to wait for a position to go into profit, and to only add in profit, and to not add in drawdown if you're using a system that uses stop losses. If you're not using a system that uses stop losses, such as dollar cost averaging, or adding to losing trades with somewhat of a martingale grid trading hybrid, then it's completely different. But if you are in fact using stop losses and risking a set percentage per trade, once your initial trade begins to move into profit, and once you add your second trade to the winner, what I personally do is I move the stop loss for the first position to break even. Now let's look at the two outcomes. The first outcome, and this is the one that happens more often than not, is that price turns around after you enter the second trade, and it goes and it stops out your original position at break even. So now you would be out of that original position, but you'd still more or less be in the same trade, just with a slightly shittier entry and a slightly closer stop loss and a slightly further profit target. And there's nothing wrong with this, and this is going to happen most of the time. And so it's important to keep those expectations realistic, because this is just simply what's going to happen. But that doesn't really matter, because every now and then you will get a situation where you started your first position and then you add a second position, and then instead of price coming back up, price continues down. Then you have the option to add another position. And every time you add another position, you can drag the stop loss for the previous position into break even. Now what happens from this location is that if price does turn around and go up, and most of the time it will, you will be stopped out at break even on one, if not both, of your previous positions, and you'll be left in the third position. And this third position will have a slightly shittier entry than your first entry or second entry, and it will have a slightly closer stop loss. Although it's the same pip distance, it's going to be slightly lower and closer to the region you entered as compared to the original position, and a slightly larger profit target. Now again, there's nothing wrong with this at all, and it's going to happen most of the time. Consider the fact that every now and then you'll also have a trade that does not go back and stop out at break even, and instead it continues falling more into profit. And it falls into profit to the point where you've added, say, 3-4 positions to your original entry. In this case, is a total of 4 positions, 3 of them being additional trades that are in profit. The importance of using this wide stop loss is such that the original entry had a stop loss that was further up here, for example, right? But it was the same distance. It was 325 pips. So the first entry looked like that exactly, and the stop loss was up there at the shown location. The next entry looked like this, the same distance stop loss, same distance take profit, and the same lot size. The third position looked like this, and then we have the fourth position now down here. Now, if price does have a very easy, quick movement off of the zone with relatively no pullbacks, then what is likely to occur is that you will have a big winning trade that can make you anywhere from 3 to 4 times what you originally risked. And even if price did go against your first position, and your first position broke above the zone, and say you closed about a third or half of the way to the profit target, then you'd lose anywhere from 1/3 of 1 unit of your risk. This is equivalent to about $300 if you were risking $1,000 at the stop loss, or you'll lose maybe half of what you risked. And in some cases, price will spike very quickly to the stop loss, and you've now lost the full 1 unit of risk. And that's okay. That's what a stop loss is for. But every now and then you will get a trade that starts moving into quite a substantial amount of profit. And after it does keep going past your final entry, which is a total of about 1/3 of the way to the profit target from the first entry. If we take this original first entry right here, and I just draw this little box going down, about 1/3 of the way to the original profit target for the first entry is about right here. Now what that means is that if price moves to that location, regardless of how many entries you've gotten, and sometimes you'll be able to get 3, 4, 5 additional trades if you're beginning your analysis in the higher time frames, because it allows the spreads to be small enough for you to enter this many positions without it being utterly ridiculous. If it gets about 1/3 of the way to the profit target and then starts going past that, I generally don't add after price has gone more than about 1/3 of the way to the final initial profit target for the first position. And then what happens is if price does get to that first position's profit target, generally speaking, I close all of my trades right there. Now, what does this mean for the risk reward? Because Garrett talks about risk reward. Do you add as long as the last position added has a reasonable risk reward? And if so, what do you consider reasonable? This is an important question, and it's a question that has kind of a counterintuitive answer. Many people will suggest that a 1-to-1 risk-reward ratio is the absolute minimum before getting into a trade. But consider the fact that you will close a lot of trades that are not working out early, and that's completely acceptable. You don't have to hold a trade all the way to a stop loss. If the stop loss was wide and gave you plenty of room to account for the market volatility, gave you a reasonable risk structure to begin adding to it if it wins, so that way your subsequent positions don't have a stop loss so close that you get stopped out on just a spike real quick. And then on top of that, the risk-reward ratios change the moment a trade starts moving into profit. Consider this for just a moment. You enter a trade that is based on a sell at a resistance zone. Price in the daily chart to come up to a resistance zone. and then it comes up to the resistance zone, and so you sell. Let's say that you have a stop loss really far above the zone, and then you have a profit target somewhere lower, and the risk reward is 1-to-1. The moment this trade starts moving into profit, say halfway to the profit target, the risk reward ratio now looks something like this. You have your current price down there, and you are risking this much to make this much. Now, this risk reward is negative. You'll see instead of a 1-to-1 risk reward ratio, it's now risking about 3 units of risk for 1 unit of gain. In other words, if you're risking $1,000 on this, you stand to make about $300, whereas originally you were risking $1,000 to make potentially $1,000. Is there anything wrong with this type of risk reward scenario? In my opinion, no. There's nothing wrong with it, as long as you do in fact have a risk structure, and as long as you have a maximum allowable loss. No matter what risk reward you use, whether it's positive, whether it's negative, or whether it's my personal favorite, neutral, a 1-to-1 risk reward ratio, it does not matter, because the moment that you enter the trade and the moment it begins moving against you or into profit, the risk reward ratio changes. All that matters is structuring the risk in such a way that allows you to make a little bit more money than you lose long term. Okay, if somebody came to me and said, Nick, I have a 90% win rate, but my risk reward is 3 units of risk to 1 unit of gain, I would tell that person that provided that they have enough trades to dictate and prove with evidence that that's actually their win rate, I would tell them to keep on going. And I would say that you should not give a fuck about the fact that your risk reward ratio is negative. Now, I also have plenty of clients who use positive risk reward ratios, and it's also more common. Say, for example, 1 unit of risk for 3 units of potential gain. Is that reasonable? Well, it really just depends. Is a person getting in and holding all their trades to the profit target or the stop loss? Are they getting in and then moving their stop loss to break even if the trade goes into, say, 1-to-1 risk reward ratio? I mean, really consider this. What is reasonable? Do you even have any idea of what you think reasonable might be? Here's what I think. I think that what's reasonable is what's profitable long term. What is more likely to make you a profit than not? If you think that I'm crazy, then try opening up an account with 1-to-1,000 leverage and entering 10 standard lots on EURUSD, and then just start adding to it as it begins to lose. Because what goes up must come down, right? And yet, this is very likely to blow your account from the onset of the first trade. Even if you win the first set of trades, you are likely to very quickly blow your account. Is that likely to make a profit long term? No, it's not. The position sizing is way too heavy. And then adding to losing trades in that kind of a context, unless you're willing to risk the whole account, is generally speaking not a good idea. So I would consider that unreasonable. Now, what if you were doing the same thing on a $1,000 account with EURUSD, and you were only using a 0.01 lot size, the smallest tradable position size with a Forex broker? If you were doing it that way and using a literal micro lot for $1,000 in the account, and you have high leverage, 1-to-500 to 1-to-1,000 leverage with a degenerate offshore unregulated Forex broker, then I would not say that that is a completely foolish strategy. Because sure, as price goes up, provided that you're spacing your entries far enough, say on EURUSD every 50 to 100 pips, you are unlikely to blow that account very easily. And if you just close the trades as soon as they come back into profit, then you're likely to make some sort of profit. And let's say you double that $1,000 account at some point, even if it takes you a year. You can simply withdraw the profits and then go back to doing the same thing over and over. Now, one would argue this isn't the best use of one's time, and that's completely understandable, but is that reasonable? In my opinion, yes. It's just because it's more likely to make a profit long term than not. So when Garrett poses the question, is it reasonable to focus on risk reward, and if so, what is reasonable? I say that provided that you've just moved stops to break even on the first set of positions, and that you've structured your risk for the initial position very clearly, in this case, quite simply selling at a daily resistance zone with a stop loss above the zone and a target right here at like a 1-to-1 risk reward ratio right around these previous lows, I would say this is a reasonable way to structure the first trade, right? It's no different than price breaking above this resistance zone and coming back and you thinking it might bounce here. And so you buy right there, you put your stop loss far below the zone, and you have your target at a 1-to-1 risk-reward ratio. In this case, it would be perfectly reasonable to enter a trade like this because the idea is that if it bounces at anywhere in this region, you're probably going to make a profit. And then, of course, you're also going to try to add to it and hope that it continues into profit without pulling back. Because when you're wrong, again, you'll lose anywhere from a third of the stop loss to maybe half of whatever the stop loss was. And worst case scenario, it will actually hit the stop loss, and then you will be stopped out of the trade, and that's okay because it's only 1 unit of loss. But best case scenario, you get into a trade that starts running into a lot of profit, and then you start making orders of magnitude more money than you would have otherwise. Now, let's consider what this would have looked like had we won this trade. The original position was 1 unit of risk right here. And if it starts going down, and if it doesn't pull back, and those are really big ifs, because this will not happen more than, in my experience, about 20% of the time, sometimes significantly less, and every now and then during volatile market conditions, significantly more. But in my opinion, and in my experience, about 1 out of every 5 trades will actually start moving into enough profit. And that's 1 out of the 5 trades that win. About the other half of the trades are going to end in some form of loss or break even. And this is completely acceptable because the risk is still structured, and it's still reasonable because it's likely to be profitable long term. If price does in fact begin moving into profit, then what's going to happen is for virtually no additional risk and just a slightly shittier entry and a slightly closer stop loss and a slightly lower risk to reward ratio, if you're looking at steadfast metrics like that and the parameters of your entry versus your stop and target, all it means is that if price has a quick move in one direction, then you're going to make a lot of money, and it's going to happen very quickly, and it's going to happen with virtually no additional risk. Meaning your original risk from what you initially risked on the trade remains constant. In this case, let's say $1,000 for this first trade. But the money that you stand to make on all the additional trades starts to add to that constant. So for example, let's say that this right here was 1 unit of risk to make about 0.7 units of gain. And then we can add all this up together right here, right now. So what we can do is we can start by going to a calculator. And what we can do is we can say we've made 1 unit of profit on the first trade. And then for the second trade, we can say that we've made, say, 0.85 units of profit. For the third entry, we can say that we've made plus let's just say 0.75 units of profit. And then for the final trade, let's just say we made something small, 0.65 units of profit, right? This is almost risking 2 units of risk for 1 unit of gain. This comes out to just over 3 units of profit. And 3 units of profit is very good, especially given the fact that when you lose, you're not likely to lose the full stop loss, right? The original wide stop loss is structured in such a way when swing trading, so that way it's just not hit. You want to try not to hit a stop loss. The only other way you can go about this is by risking a smaller amount and then using a very tight stop loss. And that works too. You're just going to have a lot more losing streaks. And one could argue what's better or worse, but ultimately it's all subjective. This right here is a system that statistically works, and you can model it for yourself in backtesting and live forward testing on a demo account, for God's sake. And then eventually, once you get enough experience, you can start doing it on a live account with small risk beginning. There are other types of trades you can take, where, for example, if you think that price is going to, say, bounce off of this support zone, then you structure the trades the same way. Support resistance is not used to predict where price is going to go. It's just to give you a way of structuring risk. Say you buy up here because you think price is going up. Where the hell does your stop loss go? Does it go underneath the recent low? Do you give it a little bit more room? Do you put it underneath the previous support zone? How about this zone down here on the daily chart? That should give it plenty of room, shouldn't it? Support or resistance just gives you a way of saying, if I buy here at this zone, and if price breaks below this zone, and if price bounces from this zone, then I have kind of an idea of what I'm going to lose if it does break the zone, worst case scenario, and then I kind of have an idea of what I stand to gain if it does in fact bounce at the zone. So for example, let's say your target was close to here on these previous highs, and then you just start off the trade with a 1-to-1 risk-reward ratio. This may seem a little bit ridiculous and unnecessary at first, but until you start looking at adding to the trade and what that looks like, you start to realize that having a big stop loss when trading these higher time frames and adding aggressively to them if they start going into profit becomes completely reasonable. It is reasonable to have a very wide stop loss that is likely not going to be hit if you're trading on charts like the 4-hour, the daily, and the weekly. Again, the profit behind this is that you've added to the winning trades with virtually no additional risk if it wins, and that if it starts to lose, you just look to exit the trade at wherever you think you should. Perhaps it's break even. Perhaps it's even a small profit and you still don't think it's going to work, so you close it. Perhaps it's a small loss, or it's halfway to the stop loss, or it hits the full stop loss. The whole point of structuring risk in trading is because you know you're going to have losing streaks. If you knew for a fact you were going to win every trade, there would be no reason to not risk the highest amount you could on a trade with the highest amount of leverage. But due to this uncertainty, you have to find a way to structure and control the risk because you know you're not going to win every single trade, even by pure statistical random chance. You can have a 50% win rate and routinely win upwards of 5 trades in a row. And it's completely random, but you don't know when or if that's going to happen. And so you have to structure the risk. Say this starts going into profit and you were able to add to it as it started spiking up. At one point here on the daily chart, price had pulled back and would have thrown you out at break even on that position. And so what do you have left? Well, you still have a 1-to-1 risk reward ratio. You still have a stop loss that's wide enough, and you still have a target that's reasonable and an entry that's still somewhere near the zone. This is virtually the same exact trade as the first one. That was the first trade right here. This was the second one. It's virtually the same trade. This is why I use such wide stop losses for the initial entry. And guess what? Even if it turned around from there and came all the way back and broke the zone, you could just close the trade right there. And then instead of taking a full loss, you've only lost half of it. If your average winning trade is such that you're making 2, 3, 4, sometimes 5 units of profit, but your average losing trade is anywhere from a fourth to a half of what the original stop loss was, you have a system that is structured in such a way that it allows you to make a lot of money. So is this reasonable? I would consider it reasonable. I would consider it completely reasonable, even if it has a lower risk reward for subsequent entries. Say in this case, for example, you add as price starts going up, and then you move the stop loss to break even for the original position. And then say that, after you've added here, price goes up even higher. So then you've added another trade up here. In this trade, it looks like that daily candle pulled back and would have come very close. So let's just consider that a stop out. You're still in the same sort of trade. And then let's say it continues going up. And then at this point, we're getting to be like, in that case, it would be halfway to the original target. So let's just say that, we didn't even add to that right there, right? Let's just say we just kept the original sort of trade on. This right here would be about 0.7 units of profit, and this right here would be 1 unit of profit. So the total profit is about 1.7 times what you risked. If you risked $1,000 in the first trade, by using the same position size for the additional entries and simply moving the stop loss to break even for each subsequent position after you add to the winning trades, and by simply keeping the stop loss distance the same and the profit target the same as the original entry, what you have is a system where you're winning on, say, for example, this trade, 1.7 units of profit. $1,000 risk made you $1,700. And what if you had lost? What if this hadn't worked? What if it didn't go up and instead price pulled back and then went and broke the zone down here and stopped out that first position? Well, in this case, if you just closed just under the zone, you would have lost 0.75 units of loss. So you would have lost $750 if you had originally risked $1,000 at the stop loss. Okay, even if it hits stop loss, which shouldn't be happening that much if you're just managing the trades dynamically and closing early once it breaks zones and once it looks like it's not going to work out anymore. Even if it hits the stop loss, this ensures that your average winner is more than your average loser, and that is what makes this profitable. So, add new positions to a trade as long as it's somewhat reasonable. Somewhat reasonable for me would just be about all the way till price gets about a third of the way to the initial profit target that you had set when you structured the risk for the new trade. That's what it means exactly. Do I add as long as the last added position has a reasonable risk reward ratio? And if so, what do you consider reasonable? I really don't look at risk reward ratio. That one rule of kind of not adding once price gets around 1/3 of the way to the original profit target, that sorts everything out in and of itself. Do I think it's reasonable to add a new position after price is 90% of the way to the original profit target? No, I don't think it's reasonable. Why? Just because of the risk situation. You have all these trades in profit and you're adding that high and you're getting so, quote, top heavy that if price has the slightest pullback, it's going to knock out a ton of your profits, knock out a bunch of positions at break even, and now you have a final remaining trade if all the subsequent positions get stopped out that has a risk reward ratio of, say, 10 units of risk to 1 unit of gain if you're adding right there as price is about to reach the final target and then price reverses. So generally speaking, I'll add to a position degenerately, profusely, persistently, completely unreluctantly until it gets about 1/3 of the way to the initial profit target based on how the initial trade was structured. And past that, I would consider it relatively unreasonable to add in most situations. Is this going to be the same exact thing for every trade? No, of course not. There's always going to be exclusions and exceptions to the rule. However, in general, that's what I would consider reasonable. Hope this helps Garrett, and to the rest of you who like this video, hope you enjoyed it. I will see you guys in the next one. Cheers.